Good morning, everyone. Welcome back to this session on mutual funds. I am CS Vivek Banerjee. Today, I will be taking this session on mutual fund, in which I will discuss the various aspects of the mutual fund, what mutual fund is, the conceptual clarity of mutual funds, the various types of funds, and in the end, we will do some practical problems on mutual fund as well. So let us. And I also want to just tell that anytime during the course of the lecture, if you find any problem or you want to ask anything, please don't hesitate and ask anytime during the course of the session. So let us begin this session on mutual funds. It is chapter 7 of your strategic financial management course. And let us see this, the first slide of this PPT. What is a mutual fund? First, read it, and then I will explain it further. Mutual fund is basically a trust, as you know, that pools together the resources of the investors to make a foray into investments in the capital market. So what is a mutual fund? Mutual fund basically is a trust that actually, you can say, collect money from the various investors who want to invest in the mutual fund, and they make investment in the capital market. Investment may be made in the shares, it may be made in the securities, it may be made in the debts. So it depends upon the risk appetite of the investor, which we will discuss during the course of this lecture. And the mutual fund is managed by the professional money managers, which collects the money from the different investors and invest in the various securities. Now, this particular slide will be more understandable by just going through it with a practical example. I will give you a practical example so that you can understand it. What is a mutual fund? Actually, how the mutual fund work? What are the various parties to the mutual fund? What are the basic steps in the mutual fund? And by taking a simple example. So I'm stop sharing here and let us go to the whiteboard. So in mutual fund, actually there are three parties, or you can say three aspects of this mutual fund. The first step in the mutual fund is the sponsor. Who is the sponsor? Sponsor is the promoter of the mutual fund, who floats the mutual fund. Who is the promoter of the mutual fund? For example, Axis Bank want to float a mutual fund. So Axis Bank Limited will be the sponsor of this mutual fund. And you can say sponsor is also a capital provider of mutual fund. Because it, in order to float a mutual fund, some money has to be put in. So the capital is given by the put by the sponsor. So sponsor is also called the capital provider of the mutual fund. Now, the second aspect of this mutual fund is the trustee. This the sponsor appoints the trust. Here you can say forms the trust. The sponsor basically forms the trust, and trust is established under the Indian Trust Act. Indian Trust Act 1882. So why this trust is established? The trust is established because the mutual fund, in order to give the investors an assurance that their money is safe. So you can say the trustees are basically the internal regulator of the fund. The trustees are basically the internal regulator of the fund. The task of the trustee is to see that this money of the investors are safe and they are invested in the you can say particular securities, and all the rules and regulations are complied with. That is basically to oversee the asset management companies. Now comes the third aspect, the AMC, that is the asset management companies. So the asset management companies are also called the AMCs. The sponsor also forms the asset management companies. The asset management companies, as the name suggests, actually manages the mutual fund. So these are the basic, you can say, steps. This way the mutual fund is formed. The sponsor, the promoter of the mutual fund, forms the mutual fund, provides money to it. Then the sponsor forms the trustee. The task of the trustee is to oversee that the money which had been put by the investors are in safe hands, are properly utilized. So it is also called the internal regulator of the fund, and to oversee the activities of the asset management companies also. The third aspect is the asset management company, which are also formed by the sponsor and which actually manages the mutual fund. Another aspect of this trustee is that trustee basically oversee the mutual fund. Therefore, it has to be an independent body. Therefore, 2/3 of the board of trustees should be independent. 2/3 of the body should be independent, and it has been and these asset management company has also to be licensed by SEBI. So this mutual fund market is entirely, you can say, regulated by the SEBI, that is Securities Exchange Board of India, the market regulator, the capital market regulator. Now, let us take you have understood that these are the three aspects of mutual fund. Let us take an example and understand this with the help of a chart. Now, the first aspect is the sponsor. Say a sponsor is Axis Bank Limited. The sponsor, that is Axis Bank Limited, forms a trustee. Trustee has to be named. For example, it may be Axis Mutual Fund Trustee Limited. And then the sponsor forms the AMC, or the asset management company. It may be, a name will be given, that is Axis Mutual Fund AMC Limited. Now, what will be the task of the AMC? The task of the AMC is to pool money from the various investors. Say, to make the example more simple, it garners money, or you can say accumulate money, from 5 investors. So from first investors, it accumulated 10,000. From the second investor, it accumulated 30,000. From the third one, 30,000. Fourth one, 40,000. And the fifth one, 50,000. 30 plus 60. 1,50,000. It accumulated total 1,50,000. And say accumulated from investors. Accumulated from investors. Now the amount which it has been accumulated will be invested. And it may be invested in, say, various securities. Means it can be invested in equity, or it can be invested in debt also. So let us say, for example, it is invested in the equity shares. So it is invested in the equity shares of company A, company B, company C, company D, and company A. Say whatever amount has been accumulated from the investors, that is 1,50,000, has been invested equally in, you can say, 5 companies. Let us say 30,000 each in every company. Now, the return, some return will be generated by this company. So whatever return which has been generated by these companies will be passed on to the mutual funds. So returns passed on to the investors. So you can say the companies cannot actually do not directly distributed the returns to the investors. Mutual fund, the companies distributed it to the mutual funds, and mutual fund distributed to the various investors. So this way, actually, the mutual fund work. The sponsor, the promoter forms a mutual fund. It forms a trustee, which is an independent body. It is the internal regulator of the fund. It sees that everything goes on well by the you can say mutual fund, and the investors' money, the investors which are putting their money into the mutual fund are safe. So it is an independent body. 2/3 body is actually independent. 2/3 of the board of trustees are independent persons. Sponsor also forms the AMC, asset management company, which actually manages the mutual fund, or it engages in the day-to-day operations of the mutual fund. Now, what the AMCs do, the task of the AMCs is to accumulate or pool money from the various investors. So in this simple example, we have assumed that it accumulated money from the 5 investors. From first investors accumulated 10,000, then 20, 30, 40, and 50,000. The total amount it has accumulated is 1,50,000. These 1,50,000 has been invested into the shares of 5 companies, A, B, C, D, E, and whatever returns have been generated by these companies are passes on to the mutual fund. Mutual fund then passes on into the various investors. And there are certain expenses on the part of the mutual fund also. So after deducting such expenses, they passes on to the return to the investors. So the expense ratio or expenses of the mutual fund, we will also see during the course of our lecture. So this is basic concept of the mutual fund. So I am rubbing it so that I can take a simple practical example. Any questions on this? You may please go ahead. No, Harshad, actually, the trust and the AMC both are formed by the sponsor only. The task of the trustee basically is to oversee the mutual fund business, that everything goes on well or not. Therefore, the 2/3, the board of trustees should be independent as regulated by SEBI. And asset management companies whose task is to manage the day-to-day operations of the mutual fund are also, formed by the sponsor only. So both of them are formed by the sponsor, trustee, as well as the asset management companies. Now, whatever I have explained in the chart, let us take a practical example on this. Say on day one when the mutual fund is formed and started its business, say today's date can be taken, that is 29/11/2021 can be taken on the day one. So on the day one, what happened? The AMC accumulated, money from the various investors. So investors, you can say investor number 1, 2, 3, 4, and 5. And the units invested, you can say units, they have invested 1,000 units, 2,000, 3,000, 4,000, 5,000. And a unit price has to be fixed. Let us say unit price is 10. Actually, most of the cases when the mutual fund companies actually issues the mutual fund, the unit price is fixed. The unit price in majority of the cases, not all the cases, are fixed at rupees 10 only. So for the simplicity of this example, I have taken the unit price as rupees 10. Now, unit invested 1000 units, unit price 10. So you can say the amount invested is the amount invested 1000 into 10,000. We will multiply it. We multiply the unit invested by the unit price. So total amount invested, we will add this 30, 30, 60, 40, 1 lakh, 1,50,000. So total amount invested is 1,50,000, and total units we will add 3,000, 6,000 plus 4,000, 15,000. 15,000 units and investment is 1,50,000. Means such 1,50,000 has been collected from the various investors. Unit price is fixed at rupees 10. Is fixed at rupees 10. And the units in mutual fund, actually, the amount has been, you can say, segregated into a certain number of units. Same as in the case of shares also, because in case of share capital, the shares, you can say share capital have been segregated into certain number of shares. This is done so that it is easier to actually, you can say, calculate the amount, or you can say make track of the various investors. So the total amount invested has been, you can say, divided by the unit price, and the units have been for the units have been issued to the various investors, just like the shares. So units have been invested by the 5 investors. Unit price has been fixed at rupees 10, and this is the total amount which has been invested by the various investors. Now, what will happen? The mutual fund has accumulated this amount, 1,50,000 from 5 investors. Now, it will invest this 1,50,000 into various, you can say, securities. In this example, I will assume that it has been invested, the equal amount has been invested into the shares. So, let us say, invested into 5 companies. So, for the sake of simplicity, I have assumed that it has been invested into the 5 companies, shares of 5 companies, and equal amount has been invested. Let us say the share price of the 5 companies, A is 10, B is 12, C is 15, D is 20, and E is 25. And the number of shares, and this is the amount invested. So let us assume that equal amount has been invested. 1,50,000 has been accumulated, and equal amount has been invested into the shares of 5 companies. Let us say 30,000 each. $30,000 each has been invested into the shares of 5 companies. Now, this that amount invested will be divided by the share price. So 30,000 divided by 10, this is 3,000. 30,000 divided by 12, let us calculate it. 30,000 divided by 12, 2,500. 30,000 amount invested divided by the share price, 15. So 30,000 upon 15, that is 2,000. 30,000 divided by 20, so 1,500, and 30,000 divided by 25 is actually coming to 1,200. So total amount which has been accumulated from the investors, that is 1,50,000, has been invested into the shares of the 5 companies. But this is day 1 actually. That is day 1. That is, you can say, 29th of November 2021. Now, my question is, will the share prices remain same every day? The answer is no. The share prices will change the next day. So let us see on day 2 what will happen. The share price on day 2 of A, say, shows an increasing trend. So it increases to, on day 2, actually decreases from 12 to 10. And the company C actually increases from 15 to 18, let us say. Shares of company D actually increases from 20 to 22. And the shares of company E on day 2, let us say it decreases from 25 to 24. So what will be the effect on the value of the investment calculated? So what will be effect on the number of shares are 3,000 and on day 2 the share prices are 12. So let us multiply it, the number of shares into the share price on day 2. It is 36,000 for company A. The company A's value of shares on day 1 is 36,000. Let us calculate it for company B. So it is 25,000, 2,500 into 10, and then again for company C, 2,000 into 18. So it will be 36,000. And for company D, it will be 1,500 into 22. It's coming to 33,000. And for company E, 1,200 into 24. It is coming to 28,800. So let us calculate the total amount, total value of the investment with 5 companies. It has added. So it is coming to 1,58,800. Is coming to 1,58,800. So you see the value of the investment on day 1 was 1,50,000 and on day 2 it has been increased to 1,58,800. So there has been an increase of 5,000, let's say 8,800 within 1 day. So let us calculate the return. What is the return? Or what is the percentage return on investment, you can see. So the return of investment, or you can say the percentage return of investment is equal to 1,58,800 minus 1,50,000 upon 1,50,000 into 100. It's a simple calculation. Let us calculate it. So 1,58,800 on day 2 minus 1,50,000 divided by 1,50,000 into 100. So let us calculate the return. So it is coming to about 5.87, right? 5.87% is the return, 1 day return. So it is decent enough. If in 1 day the return is 5.87%, it is a decent enough return. No, actually, mutual fund do not. We will come into this discussion that mutual fund do not guarantee any return. Therefore, in the mutual fund documents, you will see that the mutual fund investments are subject to market risks and we have to offer documents carefully. We will also see that in equity, you know that there is risk, but in debt fund also there are risks inherent in it. So we will see, you will get your answer during the course of this discussion. So where we are, yes, the percentage rate return on investment is 5.87%. So the return on investment in 5.87%, this will be reflected in the NAV also, because what is NAV? The net asset value. NAV is nothing but the value of the market, current market value of the investment, the present market value of the investment, because whatever investment has been made by the mutual fund into the shares are its investment, it is its asset. So net asset value basically is the asset minus its various liabilities upon the number of units. You will see the practical problems on NAV also. So it will be reflected on its, you can say, the unit price also. So unit price will also be increases with this percentage. So now what is the unit price? It will be 10 into, there is a 5.87% increase. So there is also simple calculation, 105%, 105.87%. So it will be, let us calculate it, 10 into 105.87%. So 10.587. So this is the current unit price. That is this is the unit price on day 2. It is the unit price on day 2. So this is the case, actually the NAV or the unit price changes every day, and it is the responsibility of the mutual fund to show the NAVs or the change in unit price on a daily basis to the investors, so that investors can know that how their unit price or the NAV actually increases or decreases every day. So we see that what happens on day 1 and day 2 on the investment made by the mutual fund. Now, what will the effect on the mutual fund on day 2? Let us see. So unit price is now not rupees 10, it is actually 10.587. Why this has been happened? Because of the increase in the value of the investment. So since the value of the investment has been increased by 5.87%, it is reflected in the unit price of the mutual fund also. So on day 2, the unit price is 10.587. So you can say the value of the mutual fund on day 2 is, let us calculate it, the units invested into the unit price. So on day 2 it will be 1000 into multiplied by 10.587 is 10,587. And again for investor number 2, 2000 multiplied by 10.587. Let us calculate it. 10.587. 21,174. 3000 into 10.587. So it is 31,761. Now 4,000 multiplied by 10.587 is 42,348. Now for the fifth investor, 5,000 multiplied by 10.587. It is 52,935. This is the value of the mutual fund on day 2. Let us add all these figures. So it is coming to 1,58,805. So more or less the same figure, 1,58,805 is 1,58,800. This is basically because of the some decimal points. So this way, practically, the mutual fund goes. So what happened actually? The mutual fund started its business on day one. It accumulated the money from 5 investors. It accumulated 1,50,000. It invested this amount, accumulated amount of 1,50,000 into the shares of 5 companies. The share prices are given. You multiply the share prices with the number of shares. Equal amount has been invested into the 5 companies. In practically, it is not necessary that the mutual fund will invest the equal amount. The amount will vary. But for the sake of simplicity of this example, we have assumed that the equal amount has been invested into the shares of 5 companies. So whatever amount has been accumulated, 1,50,000 by the mutual fund, has been invested into the 5 companies, entire 1,50,000. But on day 2, the value of the investment changes. Why? Because of the change in the share prices. So we have seen on day 2 that the share prices of all the 5 companies actually changes. So we multiplied on day 2, we calculate the value of investment by multiplying the number of shares by the share price on day 2. So final amount came to 1,58,800. We calculated the percentage on whatever investment that on one day, the return is actually 5.87%. Now, the value of investment has been increased by 5.87%, and it is also reflected in the, it will be reflected in the unit price of the mutual fund also, because what entire mutual fund has been invested in the shares. So mutual fund has been increased by this 105.87%, and the unit price on day 2 is 10.587. So we also then will calculate the final value of mutual fund on the, you can say, on day 2. So how it will be arrived at? We multiply the number of units invested into the unit price on day 2, which is 10.587. So it is coming to the same amount, which is the amount of the investment. So practically this way, actually the mutual fund works. So any query in this case, students, I am happy to entertain that. So guys, shall I proceed further? Okay, fine. I think we are good to go. Okay, now that we have gone through this mutual fund aspect practically with some simple example, let us read this slide again. Take 2 minutes to read this slide. I think now it will be more understandable to you. Okay, fine. So now let us let's get on to the next slide. Which is actually the evolution of the Indian mutual fund industry. This actually has been divided into, you can say, 5 phases, this mutual fund. And the first phase started from 1964. So the first mutual fund which has been introduced in India is by the UTI. So Unit Trust of India was basically established in 1963 by an act of parliament. And the mutual fund which was actually named is Unit 64, Unit Scheme 64. In short, it was called actually US 64. So the first mutual fund scheme was US 64 as early as 1964. But during the course of 1964 to 1987, there was only one mutual fund, that is US 64. Then the second phase of the mutual fund started. The second phase of the mutual fund started in 1987 and it continued up to 1993, in which the entry of various public sector funds have been, you can say, entered into the mutual fund industry. Other public sector fund means other banks came into the mutual fund industry. Public sector banks, obviously, and Life Insurance Corporation of India, General Insurance Corporation of India. These have also entered into the public sector funds. But till 1993, the entry of, you can say, the companies into the mutual fund industry was very low. There are very few mutual funds till 1993. But after this 1991-92, the reforms in 91-92, the privatization, the advent of the privatization, of the introduction of the privatization, various private sector came into the mutual fund industry. And a new era has been started in the mutual fund industry, and investors have then starting to feel a lot of choice for their investment in the mutual fund. Knowing that the SEBI also came out with some regulations, because the mutual fund industry is entirely regulated by the SEBI. The SEBI came out with a new regulations on mutual fund, that is SEBI Mutual Fund Regulation 1996. So this was the start of the third phase of the mutual fund. Then came the fourth phase, and fourth phase was from the February 2003 to April 2014. In February 2003, the Unit Trust of India Act was repealed, and UTI was actually segregated, you can say bifurcated into two separate entities. So one entity actually represented the assets of the US 64 scheme, that is Unit Scheme 64. And the second one was established as a UTI mutual fund. And it was sponsored or promoted by some public sector banks, such as public sector entities, you can say, such as State Bank of India, Punjab National Bank, Bank of Baroda, and Life Insurance Corporation of India. So this was the fourth phase. And then came the fifth phase of the mutual fund. Fifth phase has started from May 2014, and it is still continuing. And actually, from the 2014 onwards, the mutual fund get a good fillip. The SEBI is now introducing various measures to make the mutual fund industry more accessible and more reachable to the investors. Various measures have been taken to increase the investor protection. So now the investors are more confident. The investors are now more assured to, you can say, invest in the mutual funds. Now, come to the classification of mutual funds. Mutual fund can be classified into three different types: functional classification, portfolio classification, and the ownership classification. Excuse me. Now, functional classification, under functional classification, the funds are divided into two parts. That is open-ended funds and the closed-ended funds. In the open-ended scheme, the investor can make entry and exit at any time. And in this, the capital is unlimited and the redemption period is indefinite. So mutual funds are of two types, you can say: open-ended schemes, closed-ended schemes. In open-ended schemes, as an investor, you can invest in the mutual fund units at any time. Or if you want to exit from the scheme, you can exit from the scheme at any time also. There is no limit on the capital, and the redemption period, that is maturity period, is also indefinite. There is no fixed redemption period, maturity period. On the other hand, in a closed-ended scheme, the investor can buy the mutual fund during a particular period. During a particular period means during the initial public new fund offers. And in closed-ended scheme, generally the redemption period is also, you can say, fixed. In the closed-ended schemes also, the redemption period is also fixed. And the scheme has a limited life, at the end of which, and the scheme has also a limited life. Now, I will take a few minutes to stop sharing and let you understand what the open-ended funds and closed-ended schemes all together, because this is the basic foundation of the mutual fund. This is open-ended, and this is closed-ended. So open-ended schemes mutual fund means the investors can enter or exit from the mutual fund at any time, at any point of time. This is the basic advantage of the open-ended fund. The investors can get out of the scheme at any time. It can purchase the units at any time. But under closed-ended schemes, the investors can invest during a particular time period, such as NFOs, that is the new fund offer, which is for the IPOs of the mutual fund. Another aspect which differentiates the open-ended scheme from the closed-ended scheme is the open-ended schemes are not listed on the stock exchange, but the closed-ended schemes are listed. Listed on stock exchange. And in closed-ended schemes, the investor can exit from the scheme, from the mutual fund scheme, only during the only at the end of the redemption period, only at the end of the redemption period or the maturity period, or during prepayments. Prepayments means if the mutual fund is actually resorted to buyback, it is buying back its units, and in this case the investors can get back. So, in the closed-ended scheme, the investor can invest during a particular period, during the new fund offer, or during a particular time period after the listing of the shares, after the listing of the mutual funds. And it is listed in the stock exchange, closed-ended schemes. The investor cannot exit at any time, as in the case in open-ended scheme. It can exit from the mutual fund only at the end of the redemption period. Say for the mutual fund has been issued for 2 years, say for 3 years. Then after the end of the 3 years, the investors can get back their money. Or by prepayments, if the mutual fund resort to buyback and purchases its units beforehand, before the end of the 3 years, because say after the scheme is for 3 years, and the mutual fund wants to pay back the money to the mutual fund investor after 2 years, then it will be prepayments or buyback. In this case, the investors can get back their money earlier. Or it can, since it is listed on the stock exchange, closed-ended schemes, the investors of mutual fund can get out of the scheme by selling it in the stock exchange also. But practically what happens is that these closed-ended schemes are not very liquid. So it is difficult for the investors to actually sell it in the secondary market or sell it in the stock exchange. But there is no problem in case of open-ended scheme. The investors can enter at any time or it can exit at any time. So this is basically the open-ended schemes and closed-ended schemes and the difference between these two. Actually, Naveen, what happens is that in open-ended scheme, the investors can exit at any time. So the mutual fund in open-ended scheme, the mutual fund managers have to ready with that, and as and soon the redemption request, you can say, arises, it can pay the money. And it is actually the mutual fund managers, the task of the mutual fund manager actually this, because they have to ready for this and they have to keep some liquid money ready in case any such demand arises. So you can say this is you can say the pressure on the mutual fund managers to actually accede to the request of the investors. And this situation particularly makes the life of mutual fund managers more difficult when actually you can say the mutual fund do not get their money back. For example, what happens in the case of ILFS? In ILFS, the mutual funds actually invested heavily into the debt of ILFS and Divan Housing Finance Limited also. But majority of the amount had not been received by the mutual funds. So there was huge selling pressure on the mutual fund to actually pay the money. And basically the big investors who have invested crores of rupees into this mutual fund. So yes, there is a selling pressure on the mutual fund managers in case of open-ended schemes. In closed-ended schemes, there is no problem because there is a fixed maturity period and the mutual fund managers are actually ready for it. So let us get back to the PPTs again. Now come to the portfolio classification. The funds are classified into equity funds, debt funds, and the special funds. In equity funds, you can say are of following types. First is the growth funds. Growth funds are those funds which seeks to provide long-term capital appreciation to the investors and are best to the long-term investors. So the investors who have a slight risk appetite and who wants to hold funds for a long period of time, so they generally go for the growth funds because these companies actually invested in those companies which have a good growth potential. Now come to the aggressive funds. The aggressive funds are those funds in which the mutual funds actually invested in those companies which have very high growth potential or very supernormal returns which can give. In such cases, the mutual funds actually invest in the startups, IPOs, and speculative shares. As you know, recently the various successful IPOs came. The IPO of Zomato, the Paytm, and the Nykaa. Especially Zomato and Nykaa were highly successful IPOs. So, and you have also read in the newspaper that various mutual funds have invested into these, you can say, startups. So, those investors which have a good appetite for risk, they can go for the aggressive funds. On the contrary, the income funds, which is a slight, you can say, opposite of the aggressive funds. In this case, the investors are basically risk averse and they want to invest in those stocks only which continuously pay good dividends, or you can say they are highly pay high cash dividends, and in high money market instruments. Some of the companies which actually pay good dividends on year basis are, you can say, all the IT companies, Infosys, TCS, HCL, Wipro, and other companies also which regularly pays good dividend, which comes to mind. Some of the companies which actually come to mind are, you can say, Dabur, ITC, Asian Paints. These are good dividend paying companies. So you can say the investors which have a slightly less risk appetite, which are more or less of the risk averse nature, they invest it in the income funds. Okay, Navin, great. Now come to debt funds. And I also want to say that in equity, you can say there is no guarantee that whatever returns the investors are expecting, they will get it, because in equity the market is uncertain. because whatever amount has been invested in the shares, the market price of the shares may come down, and the market price may also go up, giving extraordinary return to the investors. As you can see in the last 1 year, those who have invested in equity funds have actually able to generate huge amounts. They actually are able to get huge amount of return from the mutual funds. So it depends upon how the stock market is behaving. The mutual fund manager tries to minimize the risk of the investor by investing in a portfolio of at least 15 to 20 stocks, so that if some of the stocks are not doing well, then it can be compensated by the good return by the other stocks. Now come to the debt funds. Debt funds are of two types: bond funds and the gilt funds. And the bond funds, they basically invest in the fixed income securities such as government bonds, corporate debentures, convertible debentures, money market. These are all bond funds. And gilt funds, they basically invest in the government securities. Now, come to the basic question that whether the debt funds are completely safe. The answer is no, because both the equity funds, investment in equity funds, and the investment in debt funds are subject to risk. As you have seen that, again, I am reiterating that you have seen the advertisement in mutual fund that it is saying that the mutual funds are subject to market risk. Read the offer documents carefully. Now, what are the risks in the debt funds? The first risk is basically the interest rate risk. What is the interest rate risk? The interest rate basically fluctuate according to the market value of the bonds. For example, if the bonds have been, you can say, issued at 100 and it has been increased to 110, then the interest or the yield will be actually reduced. As you have seen in the bond valuation chapter, that the income yield and the price of the bonds are inversely related. So there is an interest rate risk. That interest may fluctuate of the investors, because even the mutual fund is ready to give you 8% return on the debt funds, and the interest may fluctuate it to or come down to, it may 7.5% or 7%. And the second risk is basically credit risk. What is credit risk? Credit risk is actually the basic risk which many of the mutual fund investors have suffered while investing the debt funds. It is the risk in which the companies in which the mutual funds have invested actually defaulted on the interest and the principal money. It happens in case of ILFS, and it happened in case of Divan Housing Finance Company Limited also. Huge amounts have been invested by the mutual fund in these companies. And these companies, ILFS and the DHFL, that is Divan Housing Finance Limited, have not been able to return the money or redeem the money to the mutual funds. So since the mutual funds have not get back their money, they will have not been able to pass it on to the mutual fund investors. So mutual fund investors have suffered while investing in the debt funds. So there is a credit risk in the debt funds. And last but not the least, another risk is actually the prepayment risk. Prepayment risk means when the mutual fund wants to pay the money early. This happens when the market value of the bond, you can say, increases, and the interest rate market value of the bonds actually increases. So in such cases, if the market value of the bonds increases, then the mutual fund managers have to move to the investor. For example, the market value of bond was 100 and it has been increased to 110. Then the mutual fund have to pay 110 to the investor because now the value is 110. So in such cases, what the mutual fund does is that before the prices of bonds can escalate further, they want to prepay it. Means they want to redeem the money back to the investor so that in future they may not have to pay more. So there is a prepayment risk also in case of the bond funds. So in debt funds, there is a interest rate risk in which the interest may fluctuate, and credit risk in which the debt funds in which the investment has been made may not be able to pay back the money. And there is a prepayment risk also in which the you can say the mutual fund wants to pay their money earlier to the investors on the fear that the market value of bonds may rise or they may have to pay more at the time of the maturity. So these are the risks in case of debt funds. Now come to the portfolio classification, special funds. First is the index funds. What are index funds? Index funds are basically passive funds which invest in market indexes like Nifty and Sensex. These are basically low-cost funds and they should be invested with a long-term perspective. Let us take, guys, some time to get back to the whiteboard and understand this concept better, because index funds are very important, and it is better to, you can say, explain this with the help of an example. Okay, index funds. Index funds are basically passive funds. Why passive funds? Passive funds because they are invested in an index. They are invested in the index. So why this investing in the index will lead to passivity? The answer is that the mutual fund managers are not doing any particular research and development. They do not want to outperform the market. The mutual fund do not wish to outperform the market. Or you can say do not want to beat the market. Market means the stock market or the index in which it is in. So the index funds, the mutual fund manager basically invest in the indexes. Therefore, it is called index funds. Now, what are the indexes? Index may be Nifty 50, in which there are 50 stocks. The index may be BSE Sensex, in which there are 30 stocks. The index may be Bank Nifty, the index may be Bank Nifty, in which there are 12 stocks. The index may be Metal Nifty, the index may be Metal Nifty, in which there are 15 stocks. So there will be any benchmark, there will be any indexes. So what the mutual fund managers do in index fund, they simply accumulate the money from the various investors and they put it in the index. That may be Nifty, BSE, Bank Nifty, Metal Nifty, or any other index. So they simply wait and watch and thus hope that the index or the market perform well and give a decent return to the investors. And we have seen that in the long run, actually the stock market gives good return to the investor. So the perspective should be long term in case of index funds. The perspective should be long term. Okay, so this is what is the concept of index fund. The index funds are passive funds in which the mutual fund investors invest in the various indexes. They are called passive funds because the mutual fund investors do not resort to any extensive research. They simply invest in the indexes and wait and watch. They do not wish to outperform the market. Whatever returns have been generated by the index, they are satisfied with that. So in this case, the perspective should be long term because in the long term, generally the stock market gives a decent return. So this is what is the concept of the index fund is. Okay. I will give you some of the. I have discussed open-ended, closed-ended funds. I will take a few minutes to give you some practical example of this open-ended and closed-ended scheme. Let us go to the AMFI side. AMFI is basically this is the AMFI side, Association of Mutual Funds of India, which is actually, you can say, the administrator of the mutual fund industry. SEBI is the regulator and the Association of Mutual Funds in India is the administrator. In short, it is also called as AMFI. So you can, in AMFI side, it is recommended, you can say mandated by the SEBI that the AMFI discloses the net asset value and the expense ratio of the companies on a daily basis. So you can see the net asset value of the companies on a daily basis in the AMFI side. So let us just click on the mutual fund performances. And I have given this the open-ended scheme, equity, large cap. Large cap means the companies, top 100 companies. Mid cap means 101 to 250. Small cap companies means 250 onwards. I can click on. So these are the basically the, you can say, open-ended schemes. What are the open-ended schemes? In which the investors can enter and exit at any time. See. The latest NAV has been given 334.43 in case of Aditya Birla Sun Life Frontline Equity. 1 year return has been given, latest NAV and the previous NAV is given. So every day you can check, investors can check the NAVs or net asset value of these companies. We will discuss this regular plan and direct plan also during the course of our lecture. So my purpose is that you can see the open-ended schemes and the closed-ended schemes in this. Let us this change to closed-ended. So you can see the closed-ended schemes also here. These are the closed-ended schemes. Okay. Now I am sharing to this PPT. Let us go to the PPTs again. Okay. Now, let us get to the next point, which is international funds. So what are basically international funds? So international funds are those funds in which the mutual funds located in India raise money in India for investing it globally. And offshore funds are basically the opposite of just international funds. Offshore funds means mutual funds located in India, raise money in India, but invested abroad. So these are two parts of the international funds and the offshore funds. International funds means money, a mutual fund located in India, raised money in India, but invested abroad. And offshore funds located outside India, raised money abroad, but invested in India. So international funds, offshore funds are basically the opposite of each other. Let us see if any query comes. Namita, whatever where you have found that, I would request you to just quote it in the email also. Send me the email, because actually the closed-ended funds are listed and open-ended funds are not listed on the stock exchanges. So now come to the sector funds. So what are the sector funds? Sector funds means where the mutual fund invests in a particular sector, that is the power sector, gas sector, public works, infrastructure sector, pharma sector, metal sector. So sector funds, you can say a slightly, the risk proposition is slightly higher, because if a particular sector is not doing well, the investor will suffer. And if the particular sector is doing well, then the investor can get extraordinary return. Because during the COVID, if you remember, those who have invested in the pharma sector have garnered huge returns, and those who have invested in the construction sector, means real estate, they have suffered. Tourism sector, and you can say the entertainment industry, these sectors have suffered during the COVID. But the pharma industry, the hospital chains, the diagnostics have actually flourished during the COVID period. So sectoral funds are slightly risky, and it is more suitable for those investors who have a higher risk appetite. Now come to money market funds. Money market funds are basically debt-oriented schemes whose main objective is preservation of capital, easy liquidity, and the income. Liquid funds invest predominantly in safer short-term papers like money market instruments, as you know, commercial papers, certificate of deposits, treasury bills, government securities, etc. Student, the basic purpose of money market funds is to build basic purpose is to build an emergency corpus, because the money market funds, which are basically called the liquid funds, are considered as safer, and it is basically suited for those investors who want to invest for a very short period of time. For example, 3 months, 6 months, or for a period of 1 year. So if any investor wants to, you can say, preserve some money, accumulate some money for the purpose of any health issues, or he may want to take some break from work or sabbatical from work, or he may lose job in the future. So in such cases, the money which has been accumulated in a particular fund or emergency fund may prove to be helpful to the particular investor. So the investor may invest in money market funds or the liquid funds in order to build an emergency corpus. The next is actually fund of funds. What is fund of funds? In fund of funds, the mutual fund, the investor do not want to invest in equity or debt. They want to invest in mutual fund which actually invest in other mutual funds. The fund of fund means a mutual fund invests in other mutual funds instead of investing in debt or equity. So what is the advantage of fund of funds? Why the investor wants to invest in the fund of funds? The basic advantage is that the diversification will increase. If the diversification increase, what will happen? The securities will be more safe. Another advantage of fund is that the professional management, because one mutual fund is investing into another mutual fund. So many, you can say, the research, or you can say views of the many professional mutual fund managers will come. So the advantage of fund is professional management, higher diversification. And what is the, you can say, disadvantage fund is that the expense ratio generally, you can say, higher in case of fund of funds. So risk is lower, but there was high expense ratio, slightly higher expense ratio because of the involvement of more professional mutual fund managers. Now come to another important fund, which is the capital protection oriented fund. So capital protection oriented fund, from the name you can say, gauge out that the basic purpose is to protect the capital of the investor. So these are basically debt-oriented schemes. So majority of the capital is invested in debt and some amount is invested in the equity. So I will take some time to explain this capital-oriented fund and gold fund also. So let us first see the capital protection oriented fund. Capital protection oriented fund. So these are basically you can say predominantly invest in debt. So they predominantly invest in debt and slight portion in equity, because purpose is to actually protect the capital. And these are basically closed-ended funds. These are basically closed-ended funds, and they are basically listed on the stock exchange. And the final point is that they are mandatorily credit rated. So these are the basic features of the capital protection oriented fund. The purpose is to protect the capital. Therefore, these are predominantly debt oriented. Majority of the amount which has accumulated from the mutual fund investors are invested in the debt, and some portion is invested into equities. These are basically closed-ended funds, means the investors can get out of the scheme during a particular period only, or invest during a particular period only. These are basically listed on the stock exchange and has to be, you can say, mandatorily credit rated. So basically the safety is there. Basically the safety is there. These are basic features of the capital protection oriented fund. Some of the schemes which are capital protection oriented funds are, you can say, Canara capital protection oriented fund, and the ICICI Prudential capital protection oriented funds. Now come to the gold funds. Gold funds are suitable for those investors who wants to, you can say, do not want to physically hold the gold, but still wants to invest in the gold. So gold funds, what happens is that you can say the mutual fund do not physically hold the golds, but they invest in the gold mining companies. They invest in the shares of gold mining companies. So in this case, the mutual fund invests in the stocks of gold mining companies. The gold fund, mutual fund invest in the stocks of gold mining companies. So what are the advantages of the gold funds? Why the investor would invest in the gold funds? The advantages are some various. First is liquidity. In this case, the investors can get out of the scheme at any time. Second is flexibility. The investor can start with an amount as low as rupees 500. So investor can start with any amount, a lower amount also. This is the flexibility. And it provides the safety also, because it is safer than physical gold. Instead of holding the physical gold, they are actually invested in the gold funds. Okay, so these are the basic features of the gold funds. So any question in regard to this capital protection oriented fund and the gold funds? Okay, are we good to go? So let us get back to the PPTs again. Excuse me. Namita, there are daily AUM or asset under management means whatever assets it is holding. I will just show you. These are you are saying closed-ended scheme. Na? This is the daily AUM. AUM means the asset under management. Means whatever investment it is holding. Means HDFC Equity Opportunities Fund, the mutual fund are holding investment to the amount of 244.84 crores. Right. So this is the daily AUM or daily assets which the mutual fund is actually managing. Fine. I hope it is clear now. Now let us get back to the PPTs. Now come to the ownership classification. Funds are basically classified into public sector funds, private sector funds, and the foreign mutual funds. So public sector funds are basically sponsored by a public sector company. Public sector means the various banks, you can say Canara Bank, the State Bank of India. These have also come out with various mutual fund schemes. And the private sector mutual funds are those which are sponsored by the company of the private sector, such as various companies have in the private sector also, because you can name it Axis, HDFC, Reliance, Aditya Birla, and so on. Foreign mutual funds have also come into India long back. Which is a foreign mutual fund. Namita is asking that fund of funds disadvantage is not clear. Namita, in fund of funds, the you can say the expense ratio, the total expenses on the part of the mutual fund investor is higher. I will discuss expense ratio in which this aspect will be more clear to you. At present moment, I can only say that since the professional management is more in case of fund of fund, because what happens in fund of funds? One mutual fund is investing into the units of another mutual fund. So there is more involvement of professional managers. Since there is more involvement of professional managers, expenses will be higher, because the mutual fund managers are the highest paid, you can say, professionals in the country. Okay. So, since the involvement of such managers are more, the mutual funds have to pay more to these managers, and this will actually, if the expenses of the mutual fund will be more. Since the expenses of the mutual fund will be more, it will also be reflected on the investors also, because when the mutual fund gives return to the investor will be lower. So in such cases, since in fund of funds the involvement of professional managers are more, so you can say the expenses can be slightly higher in case of fund of funds. Okay. Fund of funds. See, I will take some time to explain this. It doesn't mean stop sharing here. In fund of funds, what happens is that mutual fund invests in other mutual fund schemes. So what happens in a hypothetical example? 15 to 20 stocks. Okay, so it is already when a mutual fund invests in a mutual fund scheme, it is also already a diversified portfolio, and it may invest in the 2 or 3 mutual fund schemes. It may not invest in the one mutual fund scheme. So it may be a one mutual fund scheme. It may be another mutual fund scheme, which may consist of 20 to 25 stocks. Okay, and so on. So the diversification will increase in case of fund of funds as a mutual fund invests in the various mutual fund schemes. So it may be more than one schemes also. So diversification will also increase and more professional managers will come into the fold. Okay. Now, get back to the direct plan. There is a difference between direct plan and regular plan. Now, let us understand this first. What is a regular plan? What is a direct plan? And what are the advantages in case of direct plan? And what are the advantages or disadvantages in case of a regular plan? I hope it is clear to you. I'm rubbing it. This capital protection oriented fund and gold funds. Just give me a second. Now this is direct plan and this is a regular plan. Okay. What happens in direct plan is that an investor can directly approach the mutual fund. You can say directly buy a mutual fund. An investor can directly buy but what happens in regular plan? I will take it as here. It will be more clear to you. So what happens in regular plan? In regular plan, the mutual fund, let us give it a name in order to understand it better. Let us see a reliable mutual fund. The name of the mutual fund is Reliable Mutual Fund. It has various investors, various distributors in the length and breadth of the country. You can say A, B, C, D, and E. And these investors, these distributors, are the various distributors. These distributors distribute the mutual fund product to the various investors. Distributes the various investors. Now, why the mutual fund take the help of distributors? The answer is simple. Because the mutual fund cannot reach to every investor on its own. It has to take the help of some agencies. Just in the case of goods, because a company cannot sold all the goods on its own, it has to take the help of the distributors, the retailers, the wholesalers. The same thing applies to mutual fund also, plus to various investors may not approach the distributor. It may directly purchase from the mutual fund by going to the particular mutual fund's site. For example, it wants to purchase a mutual fund direct plan from Axis Bank. So it can go to the Axis Bank's platform and purchase a direct fund. Now, what is the advantage in case of direct plan on the part of the investor and the, you can say, a regular plan? Expenses are low. The expenses are low. So since the expenses are low, the NAV is high. NAV is high. In this case, the regular plan, the expenses are high. So the NAV is low. Let us say in a regular plan, this reliable mutual funds expenses are actually 1.2%. 1.2% of the total fund it has been managing. 1.2%. And in direct plan, it is coming to actually 1%. Let us see. Let us say, for example, 1%. So 2%, 1.2% in regular plan expenses of mutual fund, 1.2%, and in direct plan it is coming to 1%. The reason is the distributor, because the mutual fund have to pay some commission to the distributors, because distributors selling the products to the various investors. So you can say at this point to the commission which is payable to the various distributors. So you can say that in direct plan, since the investor can directly approach the mutual fund, the expenses are lower on the part of the mutual fund, because now the mutual fund do not have to pay this to the distributor, because investors are approaching it to directly. So the expense ratio is lower on their part. If the expense ratio is lower, then NAV is higher. In regular plans, since the mutual fund actually pays some commission to the distributors because they are selling their products on their behalf, so these commissions the mutual fund will not be paying from its own pockets. It will include in the expenses and recover it from the various investors. Because when the mutual fund will distribute the returns to the investor, they will deduct this expense from the return. But in case of direct plan, the mutual fund will not deduct this 0.2%, which it was paying in the regular plan. Since it did not have to pay anything to the difference between direct plan and the regular plan. So you can say direct plan, it is advantageous from the point of view of the investor. But since there is sometimes you can say the investors feel more comfortable while approaching the distributors, because distributors have also their own research and development department, and they sometimes give the personal advices to the investors also. So some investors, in spite of having a direct plan, many investors prefer the regular plan. He's asking that how mutual fund invest in sector funds. Sector funds, I have already elaborated that in sector funds, the mutual fund invest in various, you can say, a particular sector. For example, I will give you an example of the sector fund. For example, Reliance Pharma Fund. In Reliance Pharma Fund, the Reliance will invest in the pharmaceutical sector, whatever companies are there in the pharmaceutical sector. Now, another example of this, you can say, sectoral fund, infrastructure fund, the SBI will invest in those companies which are just sector. Okay, so these are actually sectoral funds. Okay, fine. Now let us get to the types of schemes. Okay, there was one question that how international funds operate, as Indians are not allowed to invest in stock market of foreign countries. Actually, recently it has been, some provisions have been made in which the investors can invest in the you can say foreign market also. Earlier also the Indians can invest in the foreign market, but there was certain rules and regulation which have to be complied with. Since this is actually come into a legal and regulatory aspect, it is not proper to discuss this here because more time will be consumed in this. But yes, you can say the Indians can invest in the stock market. For that, we have to see the SEBI, ICDR regulation, mutual fund regulations also. So that will entirely come under the domain of the regulatory aspects. Now come to types of schemes. There are balanced funds and the equity diversified funds. Students, this balanced funds is made when the investor wants to, you can say, secure itself or wants return or good return also and wants safety also. But in balanced funds, the emphasis is both on debt and equity. But the majority of the investors want to invest in this equity, invest in this, you can say, balanced fund for the purpose of, you can say, safety as well as good returns. Okay. Now, but in balanced funds, you can say the majority that trades towards equity. So 40 to 60% are, you can say, invested in equity, and the rest of it is invested in the debts. So this is what are the features of the balanced funds. Now come to equity diversified funds. Equity diversified funds contains a wide array of stocks. You can say the fund manager for diversified fund ensures a high level of diversification in its holding, thereby reducing the amount of risk in the fund. The equity diversified means you can say diversification in many more number of, you can say, equity shares. On an average, if the mutual fund invests in 15 to 20 stocks, maybe in equity diversified funds, it may be increased to 20-25 stocks. Now come to a very important concept, this is flexi cap and multi cap fund. Because recently some of the amendments have been made in this flexi cap and multi cap funds. Before November 2020, there was no difference between flexi cap and the multi cap. But now there are some differences. What are those differences? The differences is that in flexi cap, there is no, you can say, restriction as to capping. There is no restriction as to capping. What it means? It means that the mutual fund can invest any percentage in the large cap, multi cap, or small cap. What is large cap, multi cap, or small cap? Large cap companies are those companies which are top 100 companies as per the market capitalization. Mid cap are between 101 to 250. Small cap are 251 onwards. So there is no restriction as to capping. Means the mutual fund manager can invest any amount into large cap, any amount into mid cap, any amount into small cap. But one condition is that 65% must be invested in the equity. What is a multi cap? Multi cap means there is capping as to, there is restriction as to capping. Means 25% must be large cap, 25% in mid cap, and 25% in small cap. So this is the basic difference between the flexi cap and the multi cap. Now come to contra funds. Contra funds means those funds which are basically, for the point of view of those investors, ideally suited for investors who want to invest in a fund that has a potential to perform in all types of market environment. So basically, contra fund invest in those companies which are presently not doing well, but which have the potential to do well in future. So these are basically to invest in growth. And what is the basic purpose? Basic purpose to invest at lower value so that it can encash it at higher value in the future. So these are the basic companies. Yes, with the bank Nifty, there are actually 13 stocks, 13 stocks, 12 previously, now 13 stocks. Nifty, because it is traded in the Nifty, that is why it is called Nifty, Bank Nifty. The metal stock, there are 15 stocks in the metal. So since it is traded in the Nifty, so that is what is called the metal Nifty. All the metal stocks are traded in this metal Nifty. So that is the reason. Okay. So shall I go forward, or you want to any question in this flexi cap, multi cap, or the contra fund? If you have any question, please ask. Otherwise, I will move forward. Now come to dividend yield fund. What is the dividend yield fund? Dividend yield fund invests in shares of companies having high dividend yields. High dividend yields, good dividend paying companies, as I have explained, are some of the IT companies. You can say other companies such as Asian Paints, Dabur, ITC. These are very dividend paying companies. So it is suited. Dividend yield fund are basically suitable for those investors who are basically risk averse and who wants a regular income or who wants some sort of, you can say, assurance, the safety of their funds. And these dividend paying stocks, high dividend paying stocks are generally considered as safe, because there is not too much volatility in the share price of these companies, high dividend yield companies. Now come to equity linked scheme. This equity linked savings scheme is basically for the tax. This is a tax saving initiative in which the investors get a tax deduction under Section 80C of the Income Tax Act. They can also participate in the growth of the capital market, because since it is the funds accumulated from the investors are invested in the equity, and it has a lock-in period of 3 years. Now, since this is a very important fund, equity linked savings scheme, I will take some time to explain this, what this equity linked savings scheme is. Now come to ELSS. ELSS is basically the equity linked savings scheme. So what are the advantages? First advantage is tax deduction under Section 80C. Tax deduction under 80C, it is about 1,50,000 tax deduction. Excuse me. And invested in equity. So there is a prospect of good return. Good return prospect, and has a lock-in period of 3 years. So what is the meaning of this lock-in period of 3 years? Lock-in period of 3 years means the amount invested cannot be sold, or the investor cannot get back its money within a period of 3 years. Means whatever money has been invested, for example, you have invested 1,50,000 in ELSS. So that 1,50,000 is locked in for a period of 3 years. It means for a period of 3 years, it cannot be withdrawn. You cannot get back your money. For example, you have invested rupees 1,50,000 in November 2021. So till this October 2024, you will not get this money back, 1,50,000, because it is locked in for a period of 3 years. So basically, and this can be, you can say, it seems that it is a close-ended fund, but ELSS can be open-ended as well as close-ended also. So this ELSS is an open-ended as well as close-ended fund. Okay, because why this is so? Because after a lock-in period of 3 years, means after October 2024, in this example, you can sell the units, or you can get back your money after this period, after the lock-in period of 3 years. And if it is a close-ended, then a particular period is mentioned, 5 years, 6 years. Then you can get back the money only after the such period. For example, if ELSS is been issued for 5 years, then you will get back the money after 5 years. So it can be close-ended also, and as well as can be open-ended also, this ELSS. So what are the advantages of ELS? It is a tax deduction initiative to investors, in which the investors get a maximum tax deduction of 1,50,000 under 80C of the Income Tax Act. It is basically invested in equity. Good return prospects, it is invested in equity. There is a lock-in period of 3 years, means investor cannot get back their money for a period of 3 years from the date of investment, and it can be open-ended as well as it can be close-ended also. So get back to the PPTs again. Fine. Now come to thematic funds. What are thematic funds? Thematic funds are, you can say, an extension of the sectoral funds. Sectoral funds, I have discussed that when you can say, mutual fund managers invest in a particular sector. So as an investor, if you have chosen to invest in sectoral fund, for example, you can say Reliance Pharma Fund. So if you have invested in a Reliance Pharma Fund, the Reliance will invest only in the pharmaceutical sector. So I have discussed what are the advantages and disadvantages of investing sectoral fund. If the pharma sector is doing well, you as an investor will get good returns. If the pharma sector is not doing well, presently it is not doing that well. So you will get some sort of lower return. So yes, the sectoral funds can give you high returns as well as low returns. So there is sectoral funds are basically for the risk takers, risk-taking investors. Thematic funds are, you can say, an extension of the sectoral funds, and this gives an investors and broader horizon. Means it gives the investor some sort of security. Means thematic funds are more secure than sectoral funds, and the returns are, you can say, slightly less than sectoral fund, but it gives a decent return. So what are thematic funds? Thematic funds covers more than one sectors. For example, ESG. What is ESG? I will give some time to explain this because thematic funds is slightly conceptual. So just pay attention. I am explaining this thematic funds to you. So this thematic funds, yes, it invested in, for example, invested in themes. For example, the theme is ESG. The theme is ESG. ESG means environmental, social, and governance. Environment, social, and governance. Actually, this is the current buzzword now, environment, social, governance. So those companies which are following this ESG are having a good, you can say, response from the investors. So if the theme, if you as an investor are investing in an ESG fund, so basically the mutual fund will invest in those companies which are following ESG practices. So mutual fund will invest in companies which are following ESG. Okay, environmental, social, and governance. Another example can be, let us say, manufacturing. Let us say the second theme is manufacturing. The first theme was ESG and the second theme is manufacturing. So if the theme is manufacturing, automatically certain sectors will cover under this manufacturing. For example, construction will come under manufacturing. Okay, engineering will come under manufacturing. Chemicals will also come under manufacturing. So this is construction sector. This is engineering sector. This is chemical sector. So you can say three sectors are coming under this one theme, manufacturing. So you can able to understand that the broader objective of thematic funds is to cover more sectors. So this thematic funds, you can say, are more safer than sectoral funds. More safer than the sectoral funds. So this is what thematic funds are, and This is what is the difference between these thematic funds and the sectoral funds. So I discussed both these two. If you have any further queries regarding to thematic funds or sectoral funds, you can please ask. Namita, the answer is simple. That Namita is asking that why the price of high dividend yield stocks are less volatile as compared to growth company stocks. Because growth-oriented stock, for example, the stocks of, you can say, Zomato, the stocks of, let's say, Nykaa, the stocks of Paytm are volatile because they increase or decrease. Because if you have noticed that after the listing, the Zomato's price has zoomed, and now they are somewhat stabilized. The prices are lower in comparison to what was it was after its listing. So prices have somewhat reduced after its listing. The same is the case with other IPO-oriented companies. Recently, the companies which have come out with an IPO. Few companies can break this shield and may continue to grow continuously. But there is volatility. Means prices will come up heavily and it will come down drastically. So that is why the growth-oriented stocks are volatile. High dividend yield stocks are less volatile because why they are less volatile? Because they are able to pay more dividend. Why they are able to pay continuous dividend? Because they have less profitable growth opportunity. You can say that they do not have much opportunities where they can invest their money. So they are growing, but growing at a slower pace. Since they do not have much growth opportunities, they have surplus retained earning. So whatever they do with their retained earnings, they actually passes on to the investors in the form of dividend. So that is why the high dividend yield companies are basically mature companies, and they are able to pay regular dividends because they do not have much profitable growth opportunities, and those companies are safer from the point of view of the investor, because investors know that such companies are at the mature stage. They generally give dividends every year. So volatility is less. The share price increase or decrease will be less because investors will not invest suddenly heavy amount into these stocks, or they've withdrawn suddenly heavy amount from these stocks because they know that there is not much, you can say, possibility of a growth in case of such companies, because these companies do not have much, you can say, growth opportunities. That is why they are able to declare higher dividend. We have discussed during the case of chapter on this fundamental analysis and valuation of equity shares that in case of growth-oriented companies, the value is actually higher. In case of high dividend yield companies, generally the value is slightly lower in case of the high dividend yield. The difference between the high dividend yield companies is you can say the return in case of growth-oriented companies are higher because they give more returns, but volatility is more. And high dividend yield companies, they give less return. Less returns means in the form of capital gain, capital appreciation, not in the form of dividend. So capital appreciation is less in the case of these mature companies, high dividend yield paying companies. And this volatility is more in the case of growth-oriented companies, which rarely declares dividend, or if they declare dividend, very less dividend is declared. But investors can get capital appreciation. And investors may not get the capital appreciation because the stocks are volatile. The share prices may suddenly come down drastically. Actually, this question that 1 lakh is invested in ELS as ATC deduction vary as NAV of its units vary. Actually, this is related to taxation aspect. I will not able to divulge much into it. But yes, whatever amount it has invested, it will be reflected in the NAVs. we will take questions on NAVs, practical questions on NAVs, in which this aspect will be more clear to you. But regarding this taxation aspect, I think I will not be able to, you can say, disclose much. Okay, so shall we move forward? Now come to arbitrage funds. So arbitrage funds seeks to capitalize on the price differential between the spot and the futures market. These funds are ideal for investors who want to benefit from high volatility by taking minimum risk. So these arbitrage funds also will be more clear to you when you go through the derivative chapters in your subsequent lectures. Now come to hedge funds. So hedge funds are basically aggressive funds that take advantage of derivative position in both domestic and international market. Again, this hedge fund will be more clear to you when will you go through this chapter on derivatives. Excuse me. Now come to cash fund. So cash fund is basically an open-ended scheme that generate returns with lower volatility and higher liquidity through a portfolio of debt and money market instrument. So basically, cash funds are nothing but it's actually the liquid funds. As I've explained that liquid funds, the mutual, if you have invested in a mutual fund, liquid fund. So what the mutual fund managers do is that they generally invest in the money market instruments. The money market instruments are considered as safer. So if your basic purpose is to build an emergency corpus for any health issues, for example, in future any health issue may arise, or you want to, or you may lose a job, or you want to a break from job for the purpose of further studies, then you can build an emergency corpus. So emergency corpus may be for 3 months, it may be for 6 months, it may be for one year. So for this purpose, generally the liquid funds comes handy. Why liquid funds? Because the liquid funds are for a short duration and they are generally considered as a safer, means safest among all the debt instruments. So this is what cash fund is. So these are basically liquid funds. Now there is another matter that some investors who have invested in the liquid funds or the ultra short-term bonds of this, you can say Franklin template, have suffered. Now, recently, many instances have occurred in which there is a growing perception that debt funds are also not safe. Because, as I've discussed in the course of my lecture, that whatever the amount, huge amount have been invested by mutual funds in ILFS, in Divan Housing Finance Limited, and they have suffered loss. They cannot get back their money. Since they cannot get back their money, they cannot pass into the returns to the investors also. So investors suffer. Investors of Franklin Templeton also suffer because they loses huge amount of money by investing in the short-term funds. You can say cash funds, liquid funds, ultra short-term bonds. Actually Franklin Templeton has been, you can say, returning the money to the investors slowly, but investors have suffered because their liquidity, their amount has been blocked for a long period of time. The cash fund is actually this money market fund. This is, you can say, as it has been said in, if you see this slide, that cash fund is an open-ended liquid scheme. So liquid scheme means the liquid funds. So liquid funds are basically money market funds. There is alternatively you can name them as money market funds also, because they invest in the money market instruments such as treasury bills, commercial papers, certificate of deposits, government securities, right? Okay. Now, another query which arises is that if the thematic fund, one scheme invests in one sector, so how in these funds more sectors are covered? No, actually I have discussed that in thematic funds more than one sectors are covered. Because in this example, if you see that, I will again go to the whiteboard. Please pay attention. See, this manufacturing is the theme. Okay, this manufacturing is the theme, And sectors are construction sector. In manufacturing, various sectors will be covered: construction sector, engineering sector, chemical sector. So if the investor has particularly invested in a thematic funds, just give me a second. There is one ESG fund, SBI. So if the investor has invested in a particular fund, which is a thematic fund, which is seen as manufacturing, then in such, let us try to understand what the mutual fund will do. And if you as an investor invest in a thematic fund, theme is manufacturing. What is the concept of the mutual fund? The mutual fund will garner money from you as well as thousands and lakhs of investors and invest those in the various companies which are in the construction sector, in the engineering sector, and the chemical sector. So there is diversification. Diversification is greater than the sectors. Because if you have invested in the sectoral funds, your, you can say, investment is basically constrained or basically restricted to construction only. So if the construction sector do well, you will get good return. If the construction sector didn't do well, you will not get any good return. But by choosing the thematic funds, you can say risk has been somewhat reduced because the mutual fund manager is investing in the various sectors, not restricted to a particular sector. So in thematic fund, more than one sectors are covered. I have taken an example as ESG fund SBI. For example, you are invested in this fund, ESG fund SBI. So in this situation, what the mutual fund manager will do? The mutual fund manager will invest in those companies which are pursuing ESG. Now, various companies are performing ESG, that is environmental, social, and governance issue. Because why? Because in order to increase their reputation. If the reputation is increased, this will be reflected in the share prices also. So all the IT companies, you can say, are following this environmental, social, governance, and various other companies also. So basically, invest in those companies in which are following the ESG practices. In this case, more than one sector will be covered. For example, IT sector will also be covered, and certain other companies, for example, good companies, you can say FMCG companies, pharma companies, some of the large pharma companies, which are following these ESG practices, will also come into its foray. So in thematic funds, more than one sectors are covered. It depends upon if the mutual fund is investing in the treasury bills. The basic practice is to actually invest in the RBI stocks, or whenever the RBI comes out with the treasury bills. Because what are treasury bills? Treasury bills are basically the RBI, you can say, issues bonds on behalf of the government. So the mutual fund then invest in those stocks. Because treasury bills are rarely, these money market instruments are rarely traded in the secondary market. Or even if it is traded in the secondary market, the volume is very less. Now, now come to another very important aspect, that is exchange traded funds. So what is exchange traded fund? Exchange traded fund is basically, you can say, a combination of stock and a mutual fund. There are some features of stock and there are some features of the mutual fund. And what are the features? The main feature is that, which distinguishes it from the mutual fund, is that it can be traded like stocks. Mutual funds cannot be traded, but ETFs or exchange traded funds can be traded just like the stocks. So since it can be traded, it can be bought and sold anytime during the market hours. So what are the market hours? Between 9:15 a.m. in the morning to 3:30 in the afternoon, it can be traded during the market hours from Monday to Friday. So let us just understand this exchange traded fund and distinguish it from the index fund, because index exchange traded fund has got some of the features of index fund and the stocks. The first, let us understand exchange traded fund and distinguishes it from the index fund, which is actually a mutual fund. Okay. Now I'm taking this index fund and the exchange traded fund side by side so that you can understand it better. Let us take index fund here and exchange traded fund this side. Okay. So these exchange traded funds are basically open-ended funds. So since they are open-ended funds, they are not listed. And these exchange traded funds are basically, you can say, listed because as I mentioned, they can be traded just like stocks. The first feature of exchange traded fund is this is a combination of stocks and mutual fund. And listed on the stock exchange, obviously, since it has been traded. And this index fund means this is, since it is open-ended, you can purchase it at any time, you can get out of the scheme at any time, means you can get back your money at any time. So can it be executed at can it be sold at any time during the day? The answer is no, because NAV is calculated at the end of the day. So this can be executed or purchase or sale order can be made only at the end of the day NAV. So can be executed at the end of the day NAV. But since the exchange traded funds works like stocks, it can be executed anytime during the market hours. Executed anytime during market hours. Executed anytime during the day during market hours, means 9:15 in the morning to 3:30 in the afternoon when the market closes. In this case, another aspect which differentiates the index fund from the exchange traded fund is that the expense ratio, comparatively I am telling, that exchange ratio of index fund is higher in comparison to exchange traded fund. So expense ratio is higher. Expense ratio is higher. And in this case, the expense ratio is I will take the expense ratio in detail and we will do some practical problems also in which the expense ratio will be considered. Expense ratio means whatever the expenses out of the total fund which the mutual fund is managing, means what are the expenses of the mutual fund. It may be research and development expenses, travel expenses, advisory charges. These are included under the expenses. These are the expenses of the mutual fund. So expense ratio is higher in case of index fund. Maximum index fund which is recommended by SEBI is 1%. It cannot be more than 1%. This expense ratio. And maximum the expense ratio allowed is 2.25. The expense ratio is lower in case of index fund because it is a passive fund. Why passive? Because the investments are made in the particular indexes and the mutual fund managers simply wait and watch and expect the market to perform. Okay. So there is not much research and development required. Therefore, expense ratio is low in case of index fund in comparison to other mutual funds. But if we compare this index fund with exchange traded fund, then the expense ratio is more in comparison to exchange traded fund. Because exchange traded fund, there is no involvement of mutual fund managers. Because in this case, it can just be traded like stocks. There is no involvement of the mutual fund manager. But the exchange traded fund has to be made. There is some expenses on this developing this exchange traded fund. Some people are involved in developing this exchange traded fund. For example, CNX exchange traded fund. So there is an expense ratio, but it is very negligible. So expense ratio is lower in case of exchange traded fund. And in this case, one aspect to differentiate is that since the index fund is a mutual fund, no demat account is required. No demat account is required. But in case of ETF, a demat account is required. Demat account is required since it is traded just like stocks. So there is no trading cost. Since there is no trading, there is no trading cost. And since it has been traded, there is trading cost. And there is SIP also, systematic investment plan in case of index fund. Since index fund is a mutual fund, what is the systematic investment plan? A SIP is that the investor can systematically invest periodically a particular amount. You can say every month or every quarter. So investor can start with as low as amount of rupees 500. So systematic investment plan is basically, you can say, convenient to the investor because the investor can regularly invest a fixed amount every month, and as in case of mutual fund, does not have to invest in a lump sum amount. It can start as low as amount of rupees 500. The exchange traded funds. Now, another very interesting aspect in case of index fund and exchange traded fund. This exchange traded fund is more liquid. Sorry, the index fund is more liquid and this exchange traded fund is less liquid. Why this is so? The reason is that index fund works like a mutual fund. It is a mutual fund. It is an open-ended mutual fund. Therefore, the investor can get out of the scheme at any time. It can get back its money anytime. But these exchange traded funds are basically traded just like stocks. You can purchase and sell ETFs or exchange traded funds at any time during the day, obviously during market hours. But practically, the exchange traded funds rarely traded in the stock exchange. The frequency of trading volume is very low in case of ETFs. So the investors sometimes found it very difficult to sell these ETFs. So less liquid. Therefore, the ETFs or exchange traded funds are less liquid in comparison to the index fund. So these are the basic differences between the exchange index fund and the exchange traded fund. So index funds are open-ended funds. Therefore, it is not listed. Exchange traded funds are a combination of stock and mutual funds and therefore listed. And index funds can be executed at the end of the day, NAV, because NAV is calculated at the end of a particular day. And since exchange traded funds works like stock, it can be executed anytime during the market hours. Another difference is that expense ratio is higher in case of index fund in comparison to exchange traded fund because there is involvement of the mutual fund manager. in spite of the fact that they are being passive. But exchange traded fund, there are no involvement of the mutual fund manager, so expense ratio is lower. No demat account is required in case of index fund because index fund works like a mutual fund. Exchange traded fund demat account is required because it is traded just like stocks. Since it is traded just like stocks, there is trading cost in case of exchange traded funds, and there is no trading cost in case of index fund because it works like because it is a mutual fund. Since it is a mutual fund, there is a systematic investment plan in which an investor can invest a fixed amount regularly every month or a quarter. And since exchange traded funds are traded just like stocks, there is no systematic investment plan. And the most last but not the least, which differentiate an index fund from an exchange traded fund, is that the index funds are more liquid. Why? Because it is an open-ended fund, investors can get out of the scheme at any time. And exchange traded funds are less liquid. Why? Because the investors find it very difficult to sell it in the secondary market because the exchange traded funds are very less frequently traded. Yes, Namitas, ETF can give return of both dividend. Actually, ETFs works like index fund also. The exchange traded fund also invested in the index, and the index funds also invested in the particular index or a benchmark. So you can say they are professional managers in case of ETFs also, but their involvement is very less, not like the mutual fund managers, because they are passive and just like stocks, they are being traded. There is no trading cost in case of index fund. The reason is that the index fund are not traded in the stock exchange, right? They are passive fund. They are basically mutual funds. So since there is no trading in index fund, there is no trading cost. Okay. I hope the video is now stable. Mansukh, is the video stable now? Mansukh, am I audible? It is a video. It is stable, no? Okay, thank you. Now let us move forward to fixed maturity plans. Now, fixed maturity plans are closely, you can say, just give me a second. Are closely held mutual funds in which the investor can invest during a new fund offer. So fixed maturity plans invest in certificate of deposits, commercial papers, money market instruments, and non-convertible debentures. Sometimes they also invest in bank fixed deposits. So fixed maturity plans, from the name you can understand that they are for a particular time period only. So these can be invested only during a new fund offer. What is a new fund offer? It is basically the IPOs of the initial public offer, just like IPOs of the shares. And it is since it is invested for a particular maturity period, therefore these are closed-ended funds. Now come to the various advantages of the mutual funds. First advantage is the professional management. There are professional managers in mutual fund. They are highly paid managers which engages in the research and development and which ensure that the investors get a decent return with minimum amount of risk. There is diversification, minimum diversification. A mutual fund manager invested in the at least 15 to 20 stocks. And diversification may be higher, but minimum 50 to 20 stocks. convenient administration. Now, mutual fund can be invested, works just like Demat account in shares, because whatever units you will purchase, it will be credited, and whatever you can say sell the units, it will be debited, it will be deducted. Higher returns, there is higher returns in case of mutual fund, but returns depend upon whether you are investing in the equity schemes or whether you are investing in the debt schemes. Obviously, the investment in debt schemes will generate less returns, and investment in equity schemes will generate higher returns. Another advantage is the low cost of management. The mutual fund can maximum charge 2.25%. This 2.25% is mandated by SEBI, the market regulator. And as we have seen that in the case of index fund, it cannot be more than 1%. There is liquidity in mutual fund, especially in case of the open-ended mutual fund. In open-ended mutual fund, we have seen that we can get out of the scheme or we can get back our money as an investor at any time. Now, there is transparency also. This transparency and highly regulated are basically interrelated. Mutual fund market is transparent because of the SEBI. SEBI now regulates the mutual fund market. It came out with SEBI Mutual Fund Regulations 1996. And now the mutual fund have to disclose their NAVs on a daily basis, and also the expense ratio on a daily basis in the AMFI site. So if you, I'm just stop sharing here. No, I'm giving just me get to the AMFI site. Just here. Now, if you click on this mutual fund scheme performance, yeah. Now I think it is visible in front of you. Here, if you see that it is a latest NAV position, regular and direct plan. In previous NAV means this is the NAV of the NAV of the yesterday. And day before yesterday, if you want to see the NAV, this is the previous NAV. So the information regarding NAV has to be disclosed by the mutual fund on a daily basis, so that investors can take a decision on the basis of those NAVs. So there is transparency in the mutual fund market. The mutual fund have to disclose the information on a daily basis. And here, that one thing which I want to mention here is that here, see the regular plan and the direct plan. The NAV, the net asset value of the direct plan is always greater. See, in Aditya Birla Sun Life Frontline Equity Fund, the NAV of the regular plan is 344.32, and the NAV in case of direct plan is 337.33. As we have seen during the course of our discussion, is that expenses in case of this direct plan are lower because the involvement of distribution is not there. So since the expenses are lower, the NAV is higher in case of direct plan, and NAV in case of regular plan is lower because the expenses are higher, because the involvement of distributors are there. Okay. Now, let us get back to the PPTs again. Fine. Now, come to economies of scale. Economies of scale means simple concept that as the scale increases, the cost come down, or cost come down. The mutual fund, what they do is that they generally accumulated funds, or generally get money from the thousands and lakhs of investors. So since they collected amounts from such a huge number of investors, and they collected such a huge amount of money, they can increase their scale. And because of this, the total cost actually comes down. That is what the economies of scale applies to mutual fund also. Now, this is flexibility also in case of mutual fund, because if you are invested in the open-ended funds, you can get out of the scheme at any time. Or if you want to change one fund or move from one fund to another, you can simply tell your mutual fund manager, you can exit one mutual fund and can move on to another mutual fund also. So there is flexibility in case of mutual fund also. You can move from one mutual fund to another mutual fund if a particular mutual fund is not doing well according to your opinion. Yes, Namita, 2.5% is mentioned, but now it has been recently been updated to 2.25%. So, yes, there is a recent updation that 2.25 is the maximum expense ratio. Now come to drawbacks or the various disadvantages of the mutual fund. And there is no guarantee of return. As I will reiterate again, mutual fund advertisement, it is mentioned that the mutual funds are subject to market risk. Please read the offer document carefully. We have seen that in equity, obviously, the risk is there, as you know. But in debt fund also, there is risk. And there is credit risk, there is interest payment risk, there is prepayment risk. And another drawback of mutual fund is that a diversified portfolio does not maximize return. True. Because if a mutual fund is invested in 15 to 20 stocks, some stocks will do well, some stock will not do well. So total return will eventually come down in comparison to stocks. If you invest in a stock, the chances of returns are more, but risk is more also. In mutual fund, the risk is less because diversification is more. Now, selection of proper fund on the basis of past performance. In mutual fund, this is one of the most important disadvantages of mutual fund, that selection of proper fund only on the basis of past performance. We have seen in the case of my session on fundamental analysis that you can select a stock or you can purchase a stock by going through the economic analysis, industry analysis, and the company analysis. On that basis, you can take a decision whether to purchase the shares of a company or not. But in mutual fund, you cannot do a fundamental analysis. You can only see the performance of the mutual fund because you are not getting information about which companies the mutual fund actually are investing. So that information is not disclosed to you. You can only see the performance of the mutual fund for the past, say, 3 years, 5 years, 10 years. Okay. Now come to cost factor, which is another major disadvantage of the mutual fund. There is a cost if you invest in mutual fund because mutual fund managers, I have discussed, are the highly paid managers, professional managers in the country. And they charges huge fees for the professional services they are actually provided. So cost is there, but now the SEBI has intervened and a minimum amount is fixed up to which the cost can be there. So the maximum amount, as I have discussed, is 2.25%. The maximum is the mutual fund can charge from the investors. There are certain unethical practices also which are followed by the mutual fund managers. So what are those unethical practices? You can say the unethical practice which the mutual fund actually engages to is whatever money it has accumulated from the investors, it actually invest in its sister concerns, not in any other mutual funds. For example, I have taken the example of a Reliance mutual fund. Reliance mutual fund accumulated money from the investors, and instead of investing in the equity shares of other companies, debt in other companies, or in the mutual fund of other mutual fund businesses, it simply invested money into his sister concerns. So these unethical practices were followed, but it has been reduced to a large extent because of the intervention of SEBI. SEBI is now more watchful, and it is regulated the mutual fund market more proactively. Taxes. The mutual funds are subjected to taxes also, just like the stocks. The capital gain is taxable. And the last of the drawback of the mutual fund is that the difficulties when a managed portfolio is switched to a different financial firm. Now, if a mutual fund, for example, you do not like a mutual fund, you actually exit from the mutual fund. And for example, let us take this another example, that a mutual fund business switched to a different financial firm. It exited from the financial firm and rename its mutual fund business. For example, SDFC did that. As SDFC did that, it actually changes it name of the scheme. So there is winding up upon a scheme and switch to a different scheme. So this involves some sort of cost and difficulties arises, and the investor's cost may increase because of that. The mutual fund charges, I would say the research and development charges, which the mutual fund managers charges, the travel costs, the advisory services. So these are actually the mutual fund charges, which are also called the expense ratio. Now come to the some of the practical aspects of the mutual fund. First is net asset value. So what is the net asset value? Net asset value means whatever, in the simple language, whatever subscription, whatever amount has been accumulated from the mutual funds, from the investors, is actually invested in the companies. As I have taken the example that the 1,50,000 has been accumulated from the investors and it has been invested equally among the 5 companies, in the equity shares of 5 companies. So the subscription of the investors are basically the assets of the mutual fund. Why assets? Because these are being invested in the various companies. So these investments are the assets of the company. So will be the net asset? Net asset will be the asset minus liabilities upon the number of units. So net asset value is assets minus liability upon the number of outstanding units. We will take more practical questions on NAV, in which the concept of the NAV will be more clear to you. So it is given the formula that net assets of the scheme upon number of units outstanding. This is the formula of the NAV. And what are the net assets? Net assets are market value of investment plus receivables plus other accrued income plus assets minus any accrued expenses minus payables minus other liabilities. Actually, mutual funds are, some query has been arised that why mutual funds are regulated by SEBI. Are these listed in a stock exchange? Mutual funds are regulated by SEBI because it is related to the capital market. As I have said, the mutual fund collected amounts from the investors and invest in the equity and the debt. And these are capital market. And SEBI is the market regulator, means it regulates the capital market. So since SEBI regulates the capital market, it regulates the mutual fund business also. Okay, I think now your concept is clear. And as I have said, that closed-ended mutual funds are listed in the stock exchange and open-ended mutual funds are not listed into the stock exchange. Now come to entry and exit load. What are these? Entry load means the entry fees. Means anytime when an investor purchases a mutual fund, it has to pay an entry fees. Now this entry fee is banned by the SEBI. Now no entry load or entry charges can be charged by the mutual funds. What is exit load? Exit load means what is charged at the time of redemption. Means where any amount has been redeeming at the close of a unit, then you have to pay the exit load. You have to pay investors pay an exit charge. Now the SEBI has regulated exit load also. Exit load can only be paid when you are redeeming before the maturity period. For example, you have purchased a unit for 3 years and you want redemption after 2 years, then exit load may be charged, but it cannot be more than 1%. Okay. So entry load are charged at the time of entering the mutual fund market, and exit load is charged at the time of exiting the mutual fund market. Okay, now come to trail commission. What is trail commission? Trail commission is actually different from the expense ratio. These are not charged from the mutual fund. These are basically charged from the distributors. Means if you have purchased a regular plan, what is a regular plan? Regular plan means you are purchasing the mutual fund through one of the distributors of the mutual fund. For example, Bajaj Capital. Bajaj Capital is one of the distributors of mutual fund. So, for example, you have purchased the mutual fund units from Bajaj Capital. You have purchased a regular plan. For this purpose, if you have purchased a mutual fund from the mutual fund distributors, then distributor charges certain fees from you, certain commission from you. Such commission is called as trail commission. Now, why this is so? Why the mutual fund is charging expense ratio? So, why this mutual fund distributors are charging some money from you? The reason is that the mutual fund these distributors, mutual fund distributors have certain staff. They are doing their research and development. And sometimes what happens is that these distributors provide personal advice to you as an investor. For this, the charges are nominal amount, means which varies between 0.3% to 0.75% of the value of your total investment. So minimum amount is charged by the mutual fund distributors from the mutual fund investor, which is called a trail commission. And this is different from the expense ratio, which is charged by the mutual fund. Okay, now coming to expense ratio. Expense ratio, as I've discussed, that it is the percentage of the assets that were spent to run a mutual fund. That is management and advisory services, travel costs, consultancy fees. These are come under the expense ratio. So we will be doing some practical problems day after tomorrow. My next lecture will be on Wednesday, in which I will we will see that while calculating the net asset value or while calculating the returns, the expense ratio are also considered. But this expense ratio does not include brokerage cost or trading the portfolio, because in mutual funds the trading does not involve. So expense ratio does not involve brokerage cost. And this expense ratio is also called management expense ratio. Now, before concluding, we are coming to two very important concepts of the mutual fund, that is side pocketing and tracking error. These are recent phenomena in the mutual fund. So let us take side pocketing first and try to understand what this is. Okay. Now let us come to side pocketing. I will, before discussing side pocketing, I will give a brief background. What happens in case of ILFS is that infrastructure leasing and financial services, many mutual fund companies have invested into ILFS debt funds. What happens? The ILFS starts to default because it was not doing well. And mutual fund did not get back their money. Since the mutual fund did not get back their money, it will not able to pay to its investors. So there is huge pressure on the selling pressure on the mutual funds. So that is why the SEBI has allowed side pocketing. So what is side pocketing? Side pocketing means segregating or bifurcating the illiquid assets into a separate pocket or a separate bucket. What are illiquid assets? Illiquid assets means those investments from which the mutual fund will not get their money back. Because whatever amount has been invested in ILFS, the mutual fund investor not able to get back their money. So those investments were illiquid. So what is side pocketing? Side pocketing means, you can say, segregating illiquid assets into a separate pocket, or you can say a separate bucket or a side pocket. Now, what are the repercussions or implication of this on the part of the investors? Let us see. If it is a side pocket, then it will have a separate NAV, separate net asset value. And there's the liquid assets. Liquid assets means those investment in which the mutual fund are expected to get back their money. That is, therefore, they are liquid assets. The liquid asset, there is a separate NAV. Now, if there is a separate NAV, the question arises that if the investor's money have been kept into a separate side pocket, whether the investor will be able to get back their money, or what is the, you can say, decision of the investor whether to keep their money in side pocket. The investors will get back their money in side pocket when the mutual fund will be able to recover the investments. So you can say there is wait and watch on the part of the investors. And there is a 30-day exit window. There is a 30-day exit window for the mutual fund investors. What this means is that before the mutual fund can keep this, just listen to it very carefully, before the mutual fund can keep their investment, their illiquid assets into a separate side pocket, it has to give a notice to the investor that yes, we are keeping your assets have become illiquid, we cannot recover your money, therefore we are keeping your money in a separate side pocket, and 30 days time period has been given to you in order to take a decision whether you want to exit from the scheme or whether you want to continue with the scheme. So there are two possibilities. If the investors exit, they get nothing. If the investors exit, they get nothing. And if the investors continue, they get the money as soon as the mutual fund get their money. Get the money when mutual fund recovers their investment. When the mutual fund recovers their investment amount. Now, your question may be, what is the advantage for the investor? What is for the investor? Why the investors would opt for this? The reason is that before the introduction of this side pocketing by the SEBI, there is huge selling pressure on the mutual fund, because what happens in the ILFS, what happens in the Divan Housing Finance Limited, that whatever debt funds have been invested into these companies, the mutual fund did not get back their money. So the big investors who have invested crores of rupees into these mutual funds pressurizes this mutual fund to pay back their money. So since the big investors sometimes get their money, the retail investors, the small investors suffer. So in order to provide a level playing field to the small investors, SEBI has allowed that whatever amount has become illiquid, let us keep it into the separate pocket, and distribute the liquid assets to the investor proportionately, means equally to whether it is a big investor or whether it is a small investor. So it is actually beneficial for retail investors. Actually beneficial to the retail investors. It's actually beneficial to the retail investors. I will quote a recent example of Tata corporate bond. Because some of the big actually companies have suffered recently. Tata corporate fund have invested about, you can say, 28% in DHFL, Divan Housing Finance, in the bonds of Divan Housing Finance Limited. So it also devised the side pocketing. It kept the liquid amount 28% in a separate side pocket. And this procedure, it issued a notice to the investors, 30-day notice, that if the investor exit, they will get nothing, or they may have to pay exit charges, exit charges also. And if they continue, they get the money when the mutual fund recovers their investment. So the basic, you can say, the thing which comes to the mind of the investors is that let us exit from the scheme. But the experts suggest that if anything such happens, if a amount is transferred, illiquid amount is transferred to the side pocket, the better course is to continue with the investment, because sooner or later the mutual fund will pay money to the investor, because their reputation is at stake. Big corporates are also involved in the mutual fund business. Since their reputation is at stake, sooner or later they will somehow pay back the money to the investors. So this is what the concept of side pocketing is. Any question on this? Now let us move forward and come to the another important concept, which is tracking error. Now, what is tracking error? Tracking error means if there is a deviation from the return of the mutual fund and the return of the, you can say, the index. This basically happens in case of index fund because the return of index funds and the return of the index are bound to be same. Because what happens in index fund? The mutual fund accumulate money from you as an investor and simply invest in the various indexes. Index may be Nifty or Sensex and so on. But sometimes the differences occur. So what are the why these differences occurs and what are those differences and what is their implication? So let us see. I'm going to stop sharing here. Okay, now come to the concept of the tracking error. Tracking error happens when there is a deviation from the return of deviation in return. Deviation in return from indexes. So this basically happens in case of index funds. So index funds are basically passive funds. Why passive? Because they simply invest in the index and wait for the index to generate return or perform. And this index, I have said that it may be Nifty 50, it may be Sensex 30 stocks, and it may be other indexes also, that is Nifty Metal or Nifty Pharma or any other index. So when the mutual fund, that is the index fund, invest in this, they tend to generate return. And returns are expected to be same, but they're deviation. What are those deviations? The first deviation is the, you can say, rejig in the portfolio. Rejig in the portfolio. What do you mean by that? For example, the index fund has invested in Nifty 50. The index fund has invested in Nifty 50. So there are 50 stocks. 50 stocks in Nifty. Now, in Nifty 50, what happens? The 50 stock does not remain same all the time, as you have observed also. In 50 stocks, in case of, say, presently, Tata Chemicals is there in the top 50. Now, it has been replaced by Tata Motors. It has been replaced by Tata Motors. So Nifty has been changed, but this change has to be made by the mutual fund managers also. Change in the mutual fund portfolio also. So this involves some sort of cost or some sort of changes because now the portfolio has to be changed. So some amount of negligible cost is involved. So in this way, the cost is somewhat increased. So since the expenses will increase, it will reduce the return. So there will be change in the return in index fund and the Nifty. What will be the second? Second is the expense ratio. Second is the expense ratio. So in case of index fund, the expense ratio is very negligible because the mutual fund managers are passive. But since the mutual fund managers are managing the portfolio, some amount of expenses are there. So because of this, the higher expenses will actually reduce the return somewhat. So return of the index fund will be somewhat, you can say negligibly, lower than the return generated by the index. In this case, the Nifty, I have assumed. So this is where the tracking error occurs. So higher the tracking error should not be more. So higher the tracking error, it indicates more volatility. It indicates more volatility. So this is what the concept of tracking error is. And any question on this? Yes, that is the reason. You are telling that why exit option is given. Exit option is given because in case of side pocketing, the mutual fund are following a prescribed procedure, which is mandated by the SEBI. If any investor thinks that it may not get any return in the future, somehow it is lingering or there is no possibility of any recovering, it may exit from the scheme. Some investors actually exit from the scheme. So basically, mutual fund is following a procedure which is mandated by SEBI, that 30 days time period should be given to the investor. No, actually, see, Namita, what happens in, I will just get to the PPT first. I will go to the side pocketing again. See, what happens in side pocketing? Side pocketing means illiquid assets are segregated into a separate bucket. Okay. What are illiquid assets? Illiquid assets means those investments in which the mutual funds are not able to recover their money. Means whatever investment they have made, they are not able to recover their amount, investment amount. So they are illiquid. So SEBI has allowed them to, you can say, transfer this illiquid amount or illiquid category into a separate side pocket. Now, if this has been separate side pocket, the money will be paid to the investors as and when the mutual fund recovers this from the companies. For example, in case of Tata Corporate Bond, the Tata Corporate Bond will pay to the investors in the side pocket account when it recovers the money from the DHFL, that is Divan Housing Finance Limited. As soon as it recovers the full amount from Divan Housing Finance Limited, it will pay back the money to its investors in the side pocket account. But liquid assets have been separated because these two the mutual funds do not want to club this two. Liquid funds will be proportionately paid to the investors. Why this has been done so? This has been done so to protect the retail investors. If side pocket was not there, earlier side pocket was not there. So what happens when you can say the companies default in paying their amount? Then there is selling pressure. Means the investors who are invested crores of lakhs of crores of rupees into the mutual fund, they pressurize the mutual fund to pay their amount first. So after paying those big investors, there is little amount left for the small investor. So sometimes what the mutual fund do is that they delay the payment to the small investors or the retail investors. So in order to save retail investors from that, this mechanism has been worked out, that you separate the illiquid amount into a separate bucket, and whatever liquid amount, means the amount which you can recover from the companies, the investment amount which you can recover from the companies, that amount you can pay to the investors proportionately. Means it is not that first preference will be given to the big investors and second preference will be given to the small retail investors. Everyone has to be paid amount proportionally as per the investment plan. So that is why this mechanism has been done, this side pocketing, in order to actually protect the retail investors. Namita, this tracking error leads to volatility because there is a difference in the return between these two. There is a difference in the, actually I will stop sharing it. There is difference in the return between this index fund and the Nifty 50. Higher the difference, it means there is more volatility. It means there is more rejig in the portfolio, more change. I have taken one example that instead of Tata Chemicals, Tata Motors will come. There may be other changes in the stocks also. If there are more changes in the Nifty 50 stocks in a few months, then the mutual fund manager have to change its index fund portfolio also. Okay, so there will be more expenses. Expenses will be slightly higher. So since expenses will be slightly higher, the return will be less. So there will be more tracking error between the return of the index fund and the Nifty 50. So there will be more volatility. There will be more volatility between the returns of these two, between the return of the index fund and the return of the Nifty 50, the index, that is the benchmark. Yes, so I was saying that we have seen the various aspects of the mutual fund. We have started with the conceptual clarity of mutual funds. We see various types of funds, equity funds, debt funds, special funds. We have seen the advantages and disadvantages of mutual funds. We have seen the, you can say, contemporary concepts in mutual funds such as side pocketing and tracking error also. If you have any question, you can ask. You can write to us. You can ask in my next class. My next class will be day after tomorrow, that is Wednesday, in which I will be taking more practical problems on this mutual fund. Assignment has already been shared to you, or if it has not been shared, you will get the assignment. Try to solve the question and let us meet it on day after tomorrow. So thank you for your patient listening. If you have any queries. Okay, Namita is asking another query, that why high corporate puts pressure on mutual fund to pay back money. As mutual fund, it is not necessary that investor will earn money. What happens is that yes, it is not necessary that investors will get back all their money. But since there is so much competition in the mutual fund market, now, various mutual fund are involved, private players are involved, and they want to satisfy the investors. They want to give good returns to the investors. So their reputation is at stake. If they are not able to pay back the money to the investors, their reputation is at stake, and some other mutual fund may take over that company. That is the reason why they want to satisfy the investors. Since big investors have put crores, lakhs and crores of money, they do not want to dissatisfy the big investors. So when the big investors try to pressurize them, they eventually succumb to the pressure and try to pay the money to the big investors as early as possible. So side pocketing, it is not that if side pocketing measures have been introduced, the pressure by big investor will not be exerted, but somehow it will be reduced, and it is you can say a step in the right direction for the small retail investors. So I hope that is clear to you, and this is my session on mutual fund. So I hope you have liked this lecture. Thank you for your patient listening. Thank you so much.